Hi, my name is Ross Atefi. I'm the founder and senior wealth advisor at Yatra Wealth Design. And today I'm going to be going through the Blackrock capital market assumptions, which is basically BlackRock's estimates of future returns and future risk over the next 5 to 10 years for different asset classes or types of investments. Now, we know that BlackRock is the largest asset management firm in the world. They have many trillions of dollars under management and are great at what they do. So it's really interesting to take a look at these capital market assumptions and see what's interesting or what's changed about them. Talk about how that might impact our portfolio construction going forward. So starting off here, scrolling down this again, BlackRock capital market assumptions, and we're going to go straight to the numbers here. So here's the assumptions at a glance, and I want to start off with looking at U.S. stocks, and this one right here. This is BlackRock's estimates for the U.S. stock market, really large and medium-sized companies, and what they're expecting over the next 5 years is basically a 4% per year return for the US stock market per year. And volatility, at 17.4, that's pretty standard. That's pretty high, obviously, for an asset class. But what's interesting is at 4% per year for the next 5 years, that's pretty low for the stock market. That's a low estimate and much lower than the long-term average for the stock market, which is closer to 8 to 10% per year. And I believe the reason that they're estimating only a 4% per year return for US stocks over the next 5 years is because the stock market's run up so much recently, and it's really become very expensive compared to the profits of the companies within the stock market. And so even if the companies in the stock market grow their profits and continue to grow over the next few years, the price is just so expensive right now that there's likely to be a repricing, and that's going to cause the returns to be lower over the next 5 years than a standard or period. And so based on that, I think, the takeaway here is we should probably consider being a little bit more cautious with the US stock market over the next 5 years than we have been over the last 5 years, because there's a lot more risk and a lot less return potential than normal. Some other, highlights would be the difference here between US real estate. This is privately traded, and generally I would say they're looking at commercial real estate here. So that could include, of course, office properties, which we know how challenged the office market is right now. But it also includes multifamily apartment complexes, industrial warehouse buildings, all different retail establishments, all different types of commercial real estate. Interestingly, you'll see that the return expectations for that asset class is actually only 1.9% per year, with fairly substantial volatility. And again, this is much lower than normal for U.S. commercial real estate at 1.9%, and I think it just really reflects the challenging environment for the office market, and also the challenge to real estate with the high interest rates that we're facing right now. So privately owned real estate seems like an area to also be careful on. And I tend to agree with both of those assumptions so far. Interestingly, as well, you'll see that equities or stocks not in the US, so that's this one here, they have a 5 year return expectation of 8.8%. So that's more than double what they're expecting from the US stock market over the next 5 years. And the reason they're, assuming a much higher return for, let's say, global stocks, excluding the US, is that global stocks are significantly cheaper than US stocks compared to their earnings. And so they're expecting that to kind of benefit the global stock market. They're expecting a more standard, return of closer to 8.8% over the next 5 years. So it seems like if we buy into this, we may want to add a little bit more global stocks now, as they've really kind of underperformed over the last few years. But that means that they could have a lot of room to grow over the next 5 years. Some other areas that I'd like to highlight would be listed REITs. So this is actually publicly traded real estate investments. And you'll notice that they're expecting about a 6.9% per year return. And that's a lot different than the privately owned real estate, which was only at 1.9% per year. And this also, I think this reflects the fact that publicly traded REITs are trading at a significant discount to real estate in the private markets. So if you buy, real estate through the public markets, a publicly traded real estate investment trust, you're getting a pretty substantial discount on those properties compared to their values if they were trading in the private markets. And that happens with publicly traded REITs. They'll become, they oftentimes either get undervalued or overvalued compared to that same, type of real estate in the private markets. And right now, I would say that the public REITs are actually pretty undervalued, which is, I think, what BlackRock's assumptions are kind of indicating here. So if you're going to buy real estate at this point in time, at least, publicly traded REITs look a lot more favorable than privately traded real estate. And the last thing I'd like to highlight here is direct lending. And actually, direct lending, you could also call it private credit. This looks like it actually has the best return expectation over the next 5 years, and with relatively low risk, volatility of 12%. It's about two-thirds of the 17% that the U.S. stock market expectations are. So, but about three times the returns, right? So the U.S. stock market, they're assuming a 4% per year return over the next 5 years, whereas direct lending, they're assuming a 12% per year return over the next 5 years. So three times the return, about two-thirds of the risk. What this asset class is basically making loans to private businesses. And if you do this correctly, you're making loans to private businesses that are very profitable, that are growing. Most businesses that are, that are large, have over 100 employees, are actually privately owned. By far, most of them are privately owned. And so making loans to these types of companies is not inherently risky. It's just something that a lot of investors aren't aware of and don't have in their portfolios yet. These types of loans right now, because interest rates are high, they're able to get interest rates of somewhere between 10 to 14% on these types of loans to again, very profitable, stable businesses. And so as long as you choose the right investments in this space, I think this is a reasonable assumption as well, to kind of expect somewhere close to 12% per year over the next 5 years, assuming, interest rates don't drop too much. If interest rates go down, then the returns could be a little lower than this, because this is the interest rates that they receive on this type of lending is they get a spread on the current interest rate environment. So right now, short-term rates are at 5.5%, and they're getting a spread on top of that. So maybe another 7% on top of that, which gets us to the 12-ish% return per year. If interest rates come down substantially, then returns on this could come down a little bit, but they're always going to be a lot higher than the current interest rate environment. So again, I do think this is a really favorable asset class. You just have to be careful with choosing the right providers in this space. So yeah, I just wanted to highlight a few of those really interesting elements of the capital market assumptions that BlackRock is providing. And as you're building out a portfolio, I think having something like this, whether you're referencing BlackRock's or creating your own, is really important, because you want to try to estimate amongst the different asset classes that are available, what areas seem to have the best return potential, which areas seem to have the worst, what type of risk is associated with each area. And then you kind of find a good mix based on your risk tolerance and your financial plan. Have a great day. Please let us know if you have any questions. Talk to you soon.